Good morning, everybody, and welcome to the annual general meeting of the Leicestershire County Council Pension Fund. You all should have access to the papers of the meeting, which are published on the County Council's website. The meeting is being broadcast live via Microsoft Teams Live and will be available for viewing following the meeting. In the event of having to evacuate the council chamber, please leave by one of the two exits at the rear of the chamber. Officers will be on hand to assist any person with disabilities. It is with great sadness that I report the death of Leicester City Councillor Ratilal Govind, who passed away on the 2nd of December. Councillor Govind had been a city councillor since 2015 and served on the local pension committee for a number of years. He had also been involved in the committee. I would invite members to please join me in a minute's silence in tribute to Councillor Ratilal Govind. Thank you, members. We'll now move on to item 1. I move that the minutes of the meeting held on 14th of December 2020 be approved. In favour of that? Yep, there is no dissension. I'll take that as read. Question time. We have not received any questions. Questions asked by members. We have not received any questions there. There are no urgent items. I have not been notified of any declarations of interest. So item 6 is Pension Fund Annual and Accounts 2020. So for this item, we are joined by Chris Tambini, Director of Corporate Resources, Ian Howe, Pension Manager, and Bhulesh Kachra, Senior Finance Analyst, as well as John Burns, Deputy Chief Executive Officer of LGPS Central, and Patrick O'Hara, Investment Director for Responsible Investment Engagement at LGPS Central. So this item will be followed by a question and answer session. For those online, if you wish to submit a question, please select the Q&A button on the right-hand side of the screen. You can then type in your question in the compose box and then click send. So over to you then, Chris. It's Ian.
Thank you, Chair.
Sorry. Okay.
Good morning, everybody. It's Ian Howe, Pensions Manager. As I say, I'll start this off. So got a selection of slides. So I'm just going to do a kind of a brief introduction, really, into the LGPS. It's a national scheme, the local government pension scheme. We're going to be discussing pensions administration, the investments which my colleague Bhulesh will cover, and indeed the colleagues here from LGPS Central. But I'll start with the introduction on the administration. Slides are working, but they seem a little. Right. So, Local Government Pensions Committee We have a committee here at Leicestershire. It has the delegated authority for the overall responsibility of the fund. We have 10 employer representatives, elected members and university representatives. 3 are non-voting scheme members, and the aim is to consider pension matters with a view to safeguarding the interests of all scheme members within the fund. In addition to the committee, we have the local pensions board. That's made up of 3 employer representatives, elected members, 3 scheme member representatives, and their role is to assist the administering authority in the effective and efficient governance of the admin of the scheme. The way we tend to do it here at Leicestershire, the administration tends to be more through the board and the investments tends to be more through the committee, but obviously both have a duty there of responsibility. So the admin authority, the main duties. So in pensions, I'm the pensions manager, so I head the team that deals with this particular area. We have a variety of duties, but the main ones: calculating, paying all types of pension benefits. So that's a variety of benefits for retirees and people who may leave the scheme early. We're in charge of setting up new starters and for estimates. Estimates can be to both individual employees, to scheme members, and indeed to the employers as well. We have new employers joining the scheme. We're responsible to ensure the safety and the security of the scheme, to ensure those employers that are joining safeguard the members' benefits and protect the fund. Regulation changes, so they can be statutory changes that are coming through to us that we ensure that they're implemented. Also responsible for the year-end valuation and for the annual benefit statements. Valuation is particularly important because that's where the scheme is valued, and that ultimately sets the employer contribution rates for the following 3 years. In addition to those, governance is a key area. Reports to the pensions board and as part of the fund's annual report. Some scheme fund statistics, just to kind of give you an indication of how the scheme has progressed up to the 31st of March 2021 in terms of membership. As you can see, active contributors have increased in the year to March 21. There was an increase of nearly 1,200 active members. Reserve members are members who aren't old enough yet to have claimed their pension, but do have a pension benefit entitlement in the scheme. They remain fairly static, a small drop of 117. And pensioners, as you can see there's been an increase in pensioners of just over 1,000. So the total scheme membership has increased from 95,401 to 97,530 in the year. Put some context to that in terms of the wider growth over the last 5 years. This is quite an interesting slide in terms of the membership, because you can see the contributors to the scheme, they're the people who are still paying into the scheme as active members, have increased year on year, and it's steadily increasing further. So 11% increase in the last 5 years. The preserve members, the grey line, as you can see, is fairly static and has remained so now for the last 3 years. But pensioners continue to increase. Nearly a 20% increase in pensioners over that 5-year period. So it shows that we're paying a great deal more pensioners, but we are still getting a number of active members still joining the scheme. In terms of the admin statistics in the year, this just gives you an indication of the sort of the volumes of work that are coming through the section. New entrants, nearly 6,000, just over 5,500. Retirements, 1,600. Reserve leavers, they're the people who, as I say, who have left but aren't old enough to claim the benefits, 1,250. Deaths, just over 1,000, 1,009. Sadly, we saw quite a high number of deaths in the year, particularly linked to COVID, unfortunately. But that has steadied off considerably over the previous few months. And refunds, they're people who have left the scheme who have no entitlement to a benefit. They've left with less than 2 years. 964. Transfers in and out, 271. And estimates, as I say, estimates can be from members or employers, 745. So that's a considerable amount of work that's gone through the section in the year. The work we measure that with key performance indicators, what we call KPIs. So this is the full year's KPIs in 3 of the particular areas in the business processes. We have a target. The target's that bar in the sort of the lime green, and then what we've actually achieved is next to it. So retirement benefits within 10 working days, target was 92 and we achieved 93. As you can see, the next one down, pension benefit payments, 95, we achieved 93. And deaths, 90%, we achieved 86. We were closer earlier in the year to achieving a higher score in deaths, but unfortunately, as I say, the increase in deaths did impact on us in that particular area. But as a section, I'm pleased with those 3 overall scores. Next KPIs that we score are from the customer's perspective. I won't go through each one line by line. You can look at those, but again, high scores, and we're pleased as a section with all of those areas. Just a few slides now, just on looking ahead. Really, some of the sort of the challenges. Some of them are ongoing, some of them are new, but I thought it was worth just touching on these. The McLeod Sergeant Remedy, development of member self-service, bulk admin, which I'll touch on, which is a fairly new area, and dashboards, which you may or may not have heard of already. So the McLeod Sergeant Judgment, you may recall this if you've been to the AGMs before. This is the ongoing work to provide remedy for the age discrimination that was brought against public sector pensions after the move from the final salary scheme to career average. Effectively, what happened was benefits were protected when they moved across for people who were within 10 years of retirement, and it was claimed by younger members that was age discriminatory, and they won that claim. So all public sector schemes are being reviewed and amended, and remedy is being implemented into those. We're still waiting for the final remedy for the local government pension scheme. Effectively, what will happen is we'll run benefits comparing final salary benefit to the career average, and whichever is the higher, that's what members will then receive in terms of back pay, if that is the case. The increased cost of cloud was scoped into the last valuation, so this has already been scoped in for the employer rates. System changes. This is really linked to member self-service. We have a member self-service system that members can use. That's active members, pensioners, and preserved members, so they can go online, they can look at documents, they can view their annual benefit statements, they can do their own modelling of estimates. We've got over 28,000 members signed up, but we still have many more to do. We have many more members who aren't signed up, so we're working through those members to try and get more engagement. Since in the last year, we've had a lot of work with some of the larger employers who've helped us, and they've volunteered to work with us, and they've signed up a lot of their colleagues, which has been great. But we've got a lot more employers that we want to work with in this area. Developed a new online retirement process, which now allows members to do the retirement process through the member self-service product system, and that works well. What we want to do is develop more areas in that area and move more and more work online through the member self-service system, particularly as more and more people now work from home because of COVID. It certainly helps the flow of information rather than through post. Bulk administration processes. This is a new area that we've started looking at. We're looking at developing it in the high volume areas first. So rather than effectively you run an individual calculation for each individual case by case, you can run them by bulk. So effectively you can run a number of cases in one go simultaneously. It improves efficiency and reduces admin time. And effectively it allows the resource within the section to then concentrate on other areas, particularly estimates, transfers and aggregations. The key area we're working on at the moment is preserved benefits, and that's working well. There are still some changes to be made, but it is fairly new, but it's developing well. And then we want to move on to refunds, which is another high volume area. So we're working with the system provider in that particular area, and that's something we're keen to progress. Then I wanted to mention dashboards. Now this is a national move to improve the members' pension experience. So effectively what this will mean is anybody I believe in the UK will be able to sign in to one individual place, and that will then display all their pension benefits they have from wherever those benefits are. So there doesn't have to be just LGPS, it can be from company schemes, and I believe it can be from personal pension arrangements. This is going to be growing and developing over the years, starting with the largest types of employers. Local government are obviously going to be in that category as one of the larger schemes. And we hope that that will also help us increase our member self-service take-up. So effectively, members will be able to log in through there. They'll see they've got benefits with Leicestershire, and then from there they'll be able to then contact us through, hopefully, we believe, an online sort of portal to then allow us to log into ours. Development's ongoing, and as you can see, it's got a phased implementation, and local government pensions are due to go live in 2023. That's all I was going to say, and I'll pass on to my colleague Bulash.
Thank you, Ian. A very comprehensive overview. So Bulash,
Thank you, Chair. Thank you, Ian. I think the first slide we've got here is what is pooling. Some of you will already know. Government instigated pooling of pension funds back in 2015. There are a number of pension funds set out across the country. Leicestershire is one of the Leicestershire Fund is part of LGPS Central. We have colleagues here from LGPS Central today who will talk more about their individual pool later today. The main reason for pooling here is it gives each member authority like ourselves some scale in order to provide cost savings. The total pooled or committed pooled funds by the 8 joint owners as at the 30th of September was circa 18 billion. As at the 30th of September 2021, the Leicestershire Fund had pooled or committed to pool about 2.3 billion of its fund assets. Just for comparison purposes, the value of the pool, or value of the Leicestershire Fund at that time is circa 5.5. This slide here aims to show where the Leicestershire Fund is invested with LGPS Central. So we have a number of products we've invested in. So there's 10 altogether. We have 2 active funds. So these are global equity and global emerging market. We have a passive fund, which is a climate tilted fund. Together, they comprise of 1.6 billion in assets at the 30th of September. There are 2 private equity vintages we've committed to, totaling 14 million. An infrastructure fund, circa 70. Emerging market debt, multi-asset credit, emerging market credit, and a private debt vintage. Including our LGIM assets, which are some pooled funds. The Leicestershire Fund has pooled just over half of its total funds. And when the uncalled commitments to Central are called, the proportion of our total pool will increase accordingly. We have a pie chart on the right to kind of depict where we are in total. This slide here aims to show our current investment goals. So the fund obviously has a long-term view of investment returns, so circa 20 years plus. And we've got a preference to investing with, managers which are known and have got lower risk and are established in general. And we do have a commitment to asset pooling, as you can see on the previous slide, to improve the ESG goals and obviously to provide cost savings. Got a little note at the bottom there to show the total value investment. So at the 31st of March, the fund was valued at 5.1. You'll probably remember back to the 31st of March 2020, which was near the bottom of the coronavirus dip. The value of the fund had dipped to 4.1 billion. So this slide here talks about LGPS Central and the Leicestershire Fund. So in general, when we are looking at the needs of the fund, LGPS Central is our first port of call. It gives us a single manager which provides us client support. In that we can call LGPS Central up, and we do have specific client support there, and they can go ahead and talk to all the underlying managers on our behalf. We have specific ESG specialisms. We've got Patrick O'Hara here with us today, who's the director of R&D. LCC, so the pension fund, is able to influence development of new products, and you can see that in the funds we've invested in to date. And there are a number of funds that the fund is looking to invest in 2022 also. Pie chart on the next slide just shows where the fund is invested. So you can see 62% of the fund is in what we call growth assets, and these mainly comprise of equity. So this is our passive equity and private equity and active equity. The income assets are circa 25%, and these include a wider range of products. So it includes property assets, infrastructure assets, private credit, emerging market debt, mainly income, as the name suggests. And the final classification is which comprise circa 7%, and these are the ones that should help the fund smooth out volatility and provide an equity, a cushion at least, in the event of market turbulence. And we have things like index-linked bonds and corporate bonds in that area. This slide here is a depiction of the longer-term returns. We've got by-year returns, so you can see 2016, 2017 in the top graph on the left, and 2021 up to March 31st on the right on the top graph. And the graph below that shows cumulative performance for 1 year, 3 year, and 5 year. And the 5 year returns, as you can see in the table, are 9.5% per annum. Obviously boosted by the fact that we've had 2 relatively good years in that time period, 16, 17 and 2021. Probably worth noting that the 9.5% is relatively well ahead of the benchmark. So that's the expected return for the fund with that mix of investments. That was nearly 1% ahead of where we should be, and it's worth looking at the longer term returns rather than the shorter term returns, because obviously the shorter ones can be quite volatile. Moving on to responsible investment, and not to steal too much from Patrick and Central a bit later on in their presentation, but it's worth noting that the fund had recently published its second climate risk report, which showed a reduction in the fund's carbon footprint. We do note a number there, which is about 159 tons of CO2 equivalent per $1 million of revenue, and that was a metric as calculated at the 31st of March. Our first climate risk report was calculated as at the 31st of December 2019, and the metrics included within the second report had improved in the time between the two reports. Other metrics that were also calculated include exposure to clean technology, coal, fossil fuel reserves. This slide talks about ROI in the year ahead. So what are we doing as a fund? The fund has approval to commence work on a climate strategy, which we will bring back to committee later in 2022 for approval. We are working with Central on an updated RI plan, which will come to the committee in early 2022 for approval. We also bring regular updates to the Pension Committee via Central stewardship reports. These are quarterly, and they cover 4 distinct areas, which include climate change, single-use plastics, tax transparency, and technology and disruptive industries. Development of the fund's climate risk reports will improve over time as we expect to include further asset classes to the calculation.
Thank you, Bhuvesh. So we're now going to go over to John and Patrick for presentation.
Thank you, Chair. Good afternoon. My name is John Burns. I'm Deputy CEO of LGPS Central, and with me this afternoon will be Patrick O'Hara. He's our Director of Responsible Investment and Engagement, and he'll talk through our approach to RI&E and also the role that we undertake in engagement with the Leicestershire County Council Pension Fund. If I just begin initially with a recap of what LGPS Central has been up to and the role it plays, supplementing what Bhuvesh was talking about for the fund. The point to draw out on this slide is at the bottom. You can see that the 8 investors that we are working on behalf of, we call these partner funds. In total, they have now between 50 and 55 billion of assets that we will be managing through the next few years, and as we gradually start to increase the products that we are offering to our partner funds. This slide shows in the short term that we've been established. We are now managing approximately 26 billion of assets for those 8 partner funds. We invest those in 2 principal structures. One is an umbrella collective investment fund, which generally looks after the public market investments. Secondly, a series and a suite of limited partnerships which look after our private market investments, things like private equity, private debt, and infrastructure. These 2 vehicles are divided into 19 separate subcategories of investment opportunities. Over that time, we've built a good cohort of staff. We're up to around 66 staff now. It's a mix of public and private sector expertise that's come together to offer the investment services, to build the products, provide the services to our partner funds. And in doing that and building out the business, we've seen, and we can demonstrate actively, that over the life of the funds and through the next 10 years or so to 2033, 34, we're anticipating that we can offer the fund the savings in the region of £270 million. We can do this by the opportunity that we have to run the fund efficiently, and also to leverage the external managers and engagement with external managers, such that we can offer the partner funds better rates in a collective vehicle in aggregated assets to invest. Patrick will talk later about responsible investment, but just to mention that we are assisting all our partner funds with targets and alignment to net zero over the next period. Patrick will talk more in depth about that, what he's doing for Leicester as well. And finally, on the bottom right-hand corner of the diagram, I talk about controls and governance. There's an acronym there, AAF. This is a measure, a report which is produced by our external auditors, Deloitte, which gives us a report on the internal controls in our company. This is really important to us, and it's a very good indicator of the approach that we take to control and governance. And getting a clean, unqualified report is really important to us. We're pleased to offer that, and it should give our partner funds confidence that in the ability of the organisation to run itself and manage their funds for them. If I move on just to a little bit more on the product range that we offer, the first two blue circles on the left are the funds which we have within our collective vehicle, the authorized collective vehicle. The top range, the passive funds, we run in-house. We've got a very strong internal management team there. The second blue box, the active funds, are generally run externally, where we appoint third-party managers to do that. Then the bottom blue circle in the box refers to the private markets activities that we do, some of which is managed in-house, which are co-investments, and the remainder where we outsource the management to third parties. Our performance is good in all those sectors. If I look at the top right-hand corner, the passive funds are all meeting their target tracking errors, which is a measure of their good performance. And our active funds, 4 out of 5 of them, are outperforming their own benchmarks. I'll look forward to the next years. We still have a range of products that we need to launch. First, the Global Sustainable Equity Fund, which will, I think, be a flagship for us, given the interest in that product. We're also moving into targeted return, and specifically a product which is being designed to help Leicester invest in that particular product. We're also looking at direct property and also further private equity funds. Done a lot of work quickly to launch these funds, and this will ease off as we move into the future years, as we then concentrate on reviewing and evolving our funds with our investors' input. I won't spend much time on this slide. I think, as Bhulesh did explain quite clearly, the role that LGPS Central plays in supporting Leicestershire County Council Pension Fund in its investments for the fund. Now pass on to Patrick, who will talk about I&E.
Yes, thank you. I'm Patrick O'Hara. I joined LGPS Central in January this year to head up the Responsible Investment and Engagement team. So I'll talk a little bit about how we go about doing that and the role that we play in supporting Leicester and the other partner funds in the pool in terms of their responsible investment ambitions and strategies, helping them deliver on that. So the first slide, get that one quickly. And so just to say that local authorities have been involved in responsible investment for a long time before pooling began, and Leicestershire and the other partner funds in the pool have had a very strong record in terms of engaging with government and corporates on responsible investment related issues. And it's often in partnership with LAP, the Local Authority Pension Fund Forum, who have done a really good job in engaging on some of those issues that other commercial investment managers perhaps don't want to go to and don't want to stick at it. They have a strategy of going to AGMs physically, asking questions directly to management at those AGMs. It's a very important strategy that asks those questions in front of other investors and mainstream investors, creating a dialogue that perhaps the mainstream investment management industry wouldn't embark upon in their absence. So from last AGM season, they attended the ArcelorMittal AGM and asked them about their carbon transition strategy and their transition towards hydrogen and electrolysis in terms of creating green steel. They continue to engage with BHP and Vale on reparations post Samarco and on the remediation work that needs to be delivered there, which still hasn't been delivered. They attended the AGM of Leondol Bal and challenged them on their Paris alignment and their net zero strategy. Some really important engagements there, and as some of you may well know, they're very much involved in the discussions around the occupied Palestinian territories. Yes, I can certainly. So it says LGPS Central, pool member of LAP, along with wide-ranging list of partnerships, significant experience with LGPS Central, our I&E team, engaging with companies on a variety of ESG issues, provide additional support to LCCPF on RI issues, including provision of climate risk reports. So I'll go on to the next slide and just explain in a bit more detail how we go about doing that. So as you can see there, our strategy is really very much a before and after strategy in terms of the due diligence that we'll do on our external managers before we appoint them. And the first thing is to make sure that they have a similar conviction to our own that environmental, social and governance factors are material to the performance of the business and can be financially material and impact on the share price. And then after that, we establish that they have the people, processes and systems to be able to deliver on that. So when they analyse a stock, they don't just look at the financials and the report and accounts. They look at a much broader set of criteria that describes the performance of that company and how it exists within the society in which it operates. And then after they've been appointed, assuming they're successful, and a great many of them aren't, of course, the focus then becomes on monitoring. So we have quarterly, for example, in the active equities portfolios, we have quarterly meetings with our external managers. We challenge them on any changes to the portfolio. We challenge them on engagement activities that they've undertaken. We also engage with companies, either ourselves directly through collaborative engagements or through our engagement partner, Hermes EOS. We also expect our external managers to be doing the same. So if there are companies in the portfolio that have challenges, we will identify them and we will discuss those with the external manager. And just to reiterate, we maintain all of our voting rights. So all of the companies, both our internal and externally managed portfolios, are voted by our team in accordance with our voting policy, which is approved by the partner funds at the beginning of every voting season. And we will update that and set parameters in that around things such as diversity. We require companies to achieve a certain score on the Transition Pathway Initiative, otherwise we'll vote against management. And there are a number of occasions when we've done that. So we don't just vote on shareholder resolutions, we will vote against management if we're not comfortable with disclosure or performance on climate change or any other ESG related matter. I'll move on to the next slide. So just to give you some examples of the collaborative engagements we've been involved with. So we were founding members of the Transition Pathway Initiative, and now we've joined the board. A kind of allocation of resource on our part because we recognise how important that initiative is going to be in terms of measuring the alignment of investment portfolios to net zero pathways, both portfolios and the companies held within the portfolios. So we're absolutely certain that the asset owner community need to maintain representation on that initiative. We're also part of a collaborative engagement with the Big Four accountancy firms, encouraging them and asking them to make sure that report and accounts are updated to make sure they reflect the net zero commitments and the climate transition commitments of companies. There's a bit of a disconnect at the moment between report and accounts and these commitments, and there's increasing pressure on accountancy firms to close that gap and update report and accounts accordingly. We've also been involved in a long-term engagement around deforestation, which included the Brazilian government. And in the run-up to COP, we signed a letter committing to engaging with companies to bring about an end to commodity-driven deforestation. And you will have noted that at COP26, over 100 governments also committed to that ambition. So that's an engagement that will be ongoing, and we will continue to engage with governments to make sure that they honour those obligations. Oops, sorry. And then the last one there, we've been heavily involved with the IIGCC since its commencement, and recently helped them to develop their net zero framework. So this is a net zero strategy which is being utilised by investors, particularly asset owners, to achieve net zero by 2050 and a reduction in the carbon emissions of their portfolios to 2030 in order to achieve that longer term objective. We're active members of that initiative as well. Give you an example of some of the engagements that we're involved with. We're the lead engager on the Climate Action 100 initiative with Glencore, and instrumental in bringing Glencore to the point where they now have a climate change transition plan, which they put to the AGM for vote, which outlines their net zero ambitions and their carbon reduction targets to 2035. That's a journey that Glencore have been on for some time, but now with change of senior management, it looks like it's going to accelerate. So we're very keen to maintain that conversation with Glencore and keep that going. We're actively engaged with Shell via our other partners in the Climate Action 100 initiative, and you will have seen various announcements from Shell around the turning their back on Cambo, selling their Permian Basin assets, selling their tar sands assets, and also many acquisitions in the renewable energy space. And we know there's a long journey to go. A company like Shell doesn't change overnight, but we're keen to contribute the best we can to accelerate that decarbonisation process of that business. Total Energies has been on a similar journey. You will have seen the AGM of ExxonMobil last summer, where 3 climate savvy directors were appointed to the board following a shareholder resolution put forward by a hedge fund who were supportive of that. And we ourselves tabled a shareholder resolution at Barclays in 2020, asking the company to set out a net zero strategy and align their business model with the Paris Accord. And that's resulted in Barclays issuing a strategy, developing a tool for monitoring net zero alignment. And that engagement with banks, we think, is very important in that there are a lot of private companies out there who don't come to the market for finance. We can't influence them because we don't hold their shares. They do go to banks for their funding. It's really important that banks integrate these considerations into their lending decisions, both in terms of managing risk, because as owners of Barclays, we don't want them to be running their lending book without being cognizant of climate-related risks. Also, we recognise the importance of the influence banks can have on those companies, not just on climate change, but on other issues like deforestation and palm oil and things like that. So that engagement is extended now beyond Barclays. It covers HSBC. We wrote to another 15 banks, I think it was, with similar asks, and it's now extending to Japanese banks as well. So moving on to the next slide. I just want to talk a little bit about work we're doing at the moment on net zero, and we're advocates of the IIGCC net zero framework, which would involve a number of commitments on our part. One of them would be to make sure our portfolios are net zero by 2050. That would involve a carbon reduction target of 50% by 2030. We would do this across all 4 of our main asset classes, so real estate, listed equities, fixed income and sovereign, and at the same time work on developing progress amongst private markets where disclosure is slightly weaker, but initiatives are gathering pace. Some of our private market managers have just kicked off an initiative called the Data Convergence Initiative, which sets out 6 KPIs that they will provide to investors on the ESG performance of the portfolios, of their portfolios and the companies within their portfolios, which is a really important initiative. One of the targets in the IIGC net zero framework is to have 70% of your portfolio either net zero aligned, on a net zero pathway, or subject to a net zero engagement strategy. And we're working towards that at the moment. We think we're not far off 70%, and we'll be moving that towards 100 as soon as possible. And that's a key initiative we're working on at the moment. Hopefully make some announcements regarding that before the end of the year. And then just to give you an update on some of the what's coming next. So the LGPS Central is committed to responsible investment, is committed to delivering on the strategies that the partner funds have identified. So we offer the climate risk monitoring service, and we help you to identify engagement priorities in those portfolios and climate related risks through that work. We're appointing 2 new members of the team, so the team will go from 4 to 6. The focus is really going to be on making sure that our challenge of our external managers remains as robust as it can be. We will issue a detailed net zero strategy and plan in 2022. We want to make sure that we continue to engage with the companies in our portfolio that face the greatest ESG related challenges, and make sure that our reporting around that is fit for purpose and in a format that partner funds value, and making sure that that engagement program is impact and outcomes focused. They're just some of the priorities for next year. We also want to extend our climate risk monitoring service so it covers other data points beyond climate, so other ESG issues such as water, biodiversity, human rights, so that we can report more holistically on the ESG risks embedded in the portfolios that we run on your behalf. That's all from me, John.
Thank you very much, Patrick, for a very comprehensive. The next item, I have some questions online, which I'll deal with. I think these are mainly for Ian. So, does the fund statistics include those taking on flexible retirement?
It does indeed, Chair. Yes, yeah, we do have one. Yeah.
Thank you. Does the fact that part-time work or flexible retirement, how does it affect the death in service qualifications for the beneficiaries, those left behind? So in other words, by taking part-time working, flexible retirement, how are they impacted the death in service benefits to those remaining?
Not an easy answer to give you, because every individual's benefit is obviously different depending on how much they've reduced their hours by, service they've got, whether they've got career average benefits or final salary benefits, but principally there will be an impact. If that individual wants to contact pensions, are happy to sort of do an estimate for them to show them the difference, I think would be the easiest way to answer.
That's fine, thanks Ian. So the question is anonymous actually, but I think if the member would like to contact Ian Howe direct regarding your specific benefits, that would be fine. We have a question from Barty. Will the dashboard include a view of AVCs? I'm not sure how relevant. I don't know enough to know.
It's a good question. That is a good question. That's a good question. There's ongoing national decisions to be made in terms of how dashboard is rolled out and what's included and when. I understand there's discussions around a variety of different sort of sub benefits, of which AVCs are one. So the answer at the moment is we don't yet know, but I would expect at some point there will be, because the intention of dashboards is so a member can see all their pension benefits in one place. So I would expect yes, but I can't say for definite yes on that point.
Thanks for that. And the final was really a comment rather than a question. It says thanks to the support from the team, Alison Taylor, Jane Norman, James Buller. So that's so the okay. Okay, so we have one more question from regarding responsible investment. I think Bulesh, have you got the wording there?
I think I do, Chair. Thank you. Question. How will the LGPS balance the need to transition to more ESG focused investments whilst continuing to seek good returns for members? How are you mitigating the risk of lower return? So I think we can answer this with the fund's investment strategy statement draws a distinction between ethical and responsible investing. Invests with an RI mindset, that's responsible investing mindset rather than ethical mindset. I do believe that investing with an RI mindset does give you better risk adjusted returns. So it's not as if investing with ESG in mind should detract from returns. If anything, we believe complements.
Okay. So isn't it? So presentation. So we've got one other question. Based. Pretty much covered by the presentation, but you, Patrick.
So our approach is to integrate environmental, social and governance considerations into investment decisions because we think that's a better way of managing risks arising out of those issues. We don't make ethical judgments per se on certain activities being acceptable or not. We don't kind of impose our ethical judgments on that process. But ethics clearly can become financially material and material to the performance of the company through either reputational damage, regulatory censor, or the fact that partners and customers don't wish to transact with that company anymore. So we're very cognizant of ethical risks. We don't make ethical judgments in that sense.
Okay, thank you. I've got a few more here. Are all investments fair and transparent and also diverse in relation to links with different cultures, etc.?
Well, all of the all of the portfolios are so the listed equity portfolios. The underlying assets are available. They're all listed companies, so all of those companies are subject to regulation and listing rules in the jurisdictions where they're listed. And there is I guess there is a tension between what some companies might consider to be local laws and local practices. But we do take, some things are immutable, and we do take a view on certain issues such as human rights and health and safety, that regardless of what local practices might be, companies should set their own tolerances and levels of behaviour around these things, and they should apply them globally. So the answer to that question is yes, to an extent.
Thank you. And we've got two more questions. What do you mean about the Palestinian territories? I think, Patrick, you mentioned Palestinian territories within your presentation. What exactly?
So in the occupied Palestinian territories, there are some global companies that offer services, internet-related services, such as Motorola and Booking.com. And that comes with it some controversy because they are facilitating economic activities in those areas. And whilst that's a very small proportion of their revenue, it is controversial. It is a matter of interest to members of a number of the schemes that we manage. So we have engaged with those companies. We have sort of LAP. We've asked them about the human rights policies they have in place. We asked them about how they ensure equality in terms of opportunity and employment rights for both communities. So that's basically the engagement.
Thank you. And one last one. Will the fund enable us to pool our private pension funds in the future? So this again, this anonymous question. If I could ask Ian to answer that one.
No, they won't. The fund made a decision a number of years ago that we wouldn't allow people to transfer in other pensions into the fund to pull them together. The only transfers that we'll accept are from what we call club arrangements, which tends to be other public sector schemes like the NHS, teachers, things of that nature, civil service. And they have to be made within the first 12 months of transferring in, and they can, of course, transfer in from other local authority funds.
Okay, thank you. Thanks very much, Ian. Now, I've got two questions from the audience. I will take them both. If I could ask the gentleman at the back, I think on the left there, if you could step forward and press the button that says speak and then ask your question. That's it.
Yeah. Good afternoon, Chair. I'd like to ask the committee and LGPS Central here when they expect to see tangible reductions in the carbon emissions of the fossil fuel companies this fund invests in with their engagement policy, because we haven't got much time. And it's said in one of the files that it's a long game, but when you like to see that, you may mention again of ExxonMobil changing the board, members of the board there, and also Shell's recent decision to put Cambo. But are either of these things going to bring any benefits to the environment in terms? I mean, the Cambo thing, was that because of your engagement? Did that happen because of that? Is that when you can hold up your head and at the end say, we'd be delighted if it was? That's first. Another thing is, are they aware of the risk of some of these companies becoming stranded assets, and where they may not be providing benefits to the scheme financially when's the moment to pull out on that basis?
Thank you. Good question, Patrick.
Yeah, so on the first point, I think the problem with engagement is it's always really hard to say that you've brought about an event or a change in behaviour, because we know that there's a multitude of investors engaging with these companies. Some investors are not engaging in the way that we are in terms of encouraging them to decarbonise, to shift their business model to a lower carbon economy. Other investors are taking more of a hard line in terms of dividends and profits. But I know for the fact that the Climate Action 100 and that engagement is led by the Church of England on that particular one. They have a very strong relationship and a line into the management of Shell, and they've been engaging quite hard on Cambo. They said in the press release that it was about economic considerations. I'm not entirely convinced myself that that would have been the only consideration here based on what the current oil price is. And the other partners in the Cambo initiative seem to think that it has a lot of potential and it's a very attractive investment opportunity. But I can only speak what Shell have said publicly on that. With regard to divestment, I mean, our approach is predicated on the fact that all fossil fuels are different. So coal, gas, oil all have different stranding risks. It depends on how high up the cost curve the assets are in terms of how much it costs to dig a barrel of oil out of the ground, as to how that asset faces the risk of stranding. If we think that probably the best tool that governments have for stranding is through the application of a carbon price or a carbon tax, then that cost of production is very material in terms of which assets will strand first. We also see that there's some, not necessarily a realisation that I particularly like, but there is some role potentially for gas as a bridging fuel, and it could displace coal in the energy mix, which would be helpful in terms of short-term reductions in carbon emissions. And all companies are different. So through ESG integration, we expect our external managers, our fund managers and their analysts and the people who provide them with research and analysis to be factoring in these issues and these risks. We expect this to be embedded in the valuation that they make of the company. And we expect them to be taking a long-term view. And we will challenge them on that. And I personally think that's probably likely to lead to the best outcomes in terms of both, whilst we are invested, we can try and accelerate this transition by giving management a hard time and making sure that they get a different message from investors. We can tell governments that we're quite comfortable with them regulating, legislating around this, so they don't have to worry about that. And there will be some companies like Exxon we mentioned and others that will bury their head in the sand and not transition. We don't expect to see those companies in the portfolio, but other companies which are showing leadership and are showing an opportunity, if external managers can justify that and justify their valuation and explain the risks and how they got comfortable with those risks, I think that's probably likely to lead to the best outcomes for beneficiaries rather than a blanket divestment strategy. The other thing we're cognizant of and we're being encouraged to consider is the just transition. And the hundreds of thousands of people who work for the oil and gas industry around the world are going to need to look for alternative employment. And that needs to be a transition as well and managed compassionately and responsibly. So again, we think this ESG integration is the best approach for contributing positively to those three outcomes.
Thank you very much, Patrick, for comprehensive. It's clear there is quite a lot of work going on. So, Jeff, if I can ask you to ask a question.
Thank you, Chair. I'm Jeff Lawrence. I'm a pensioner member of the scheme, and my question really is, but when the LGPS central investment managers are engaging with businesses over their environmental and social impact, criteria do you use to decide whether the company's business strategy meets the expectations of the pension fund's investment strategy in terms of climate impact?
Yeah, so, and again, this is a kind of a developing area, but one of the things we look at is the Transition Pathway Initiative, which models transition pathway for different sectors in the economy. And we look to see whether that company is on that pathway in accordance with what's been modelled. They're science-based pathways. They come from, they're extrapolated from net zero and Paris Accord targets that are agreed by international governments. So that's one metric that we use. We challenge them on capital expenditure, making sure that their capital expenditure is aligned with their targets as well. That, you know, we challenge them on the report and accounting that they deliver, on the reporting of making sure that report and accounts are reflective of these challenges and their stated ambitions. We challenge them on their lobbying activity to make sure that they're not saying one thing publicly and then the industry bodies that they're members of are saying one thing privately with governments and regulators. Another very important area where I think investors can contribute, hold companies' feet to the fire. And a collaborative engagement that we've just kicked off following a piece of academic work that was done by a professor at University College Dublin, which suggests that Scope 1 and 2 emissions that these companies are not as accurate as they should be. We're embarking on an engagement with Brunel and the Church of England. We're writing to 20 oil and gas companies, ask them to do that better. And pointing out the weaknesses in the numbers. What we want to get is like a double entry bookkeeping type approach to carbon emissions, making sure that they add up across the reporting frameworks. And then the other thing off the back of that, which is again is really important, is that these companies at some point, and not just oil and gas, just large operations, may well end up relying on offsets to get to net zero. And the calculations of those offsets, validity of those offsets, needs to be very carefully looked at. As owners of these companies, challenge them on making sure that propose that regard adds up and makes sense. And beyond that, just general disclosure. You know, it took a long time for some companies to report Scope 1 and 2 emissions at all. We want them to embrace the Scope 3 emissions, which is more challenging. In fairness, it's a challenge that companies have to accept that they're also responsible for other people's emissions, i.e. the users of their product. I think it's an important consideration and change in behavior that we need to see from large corporations. Does that answer your question?
Okay, so we don't appear to have any other questions. Thank you very much for the questions that have been brought forward today, and thank you, Patrick, for your very comprehensive answer to all of those. Appreciated. So the next item we have on the agenda is the Local Pension Board Annual Report. A report compiled by the Local Pension Board has been included in the agenda pack for today's meeting and was published online with the agenda papers. The chairman of the board, Mrs. Rosita Page, has had to give her apologies, but the report gives a comprehensive update on what the board's work and what they have been doing throughout the year. So I'd recommend scheme members to have a read. It was particularly pleasing to note that the board has no concerns over the fund or its administration and their oversight of issues such as the McLeod issue, employer risk and performance of the fund's additionally voluntary contributions provider. We will take the report as noted. Item 8 is the election of employee representative to the Local Pension Committee. We have received one nomination for the position of employee representative on the Local Pension Committee. The nomination is for Mr. G. Lawrence. No ballot is therefore required, and Mr. Lawrence will be appointed to the committee for a period of 3 years. The current staff representatives elected to the committee are therefore Mr. G. Lawrence, newly appointed for a period of 3 years, Mr. Nick Booth to remain a staff representative for a period of 2 years, and Mr. A. Wilson to remain a staff representative for a period of 1 year. So welcome, Jeff, and we look forward to seeing you for the next 3 years at least. The next item is item 9, the election of employee representative to the local pension board. We have received 1 nomination for the local pension board. The nomination is Mr. M. Saroya. No ballot is therefore required, and Mr. Saroya will be appointed to the board for a period of 3 years. The current staff representatives elected to the board are therefore Mr. M. Saroya, newly appointed, Mrs. C. Fairchild to remain a staff representative for a period of 2 years, and Mr. R. Gilbert to remain a staff representative for a period of 1 year. There is now a vacancy for the role of reserve employee representative, and details of anybody who wishes to apply for that are available and within the papers. So please, if anybody wants to be a reserve member, please come forward. Item 10 is any other urgent items. As mentioned earlier, there are no urgent items. And item 11, I will move that officers be requested to determine an appropriate date and time for the next pension fund annual meeting in 2022 and publicise this date on the fund's website. Now that concludes the annual general meeting. I thank you all very much for your attendance. There's been some good questions and answers, and very much appreciated the input of Ian, Patrick and John, and also Bulesh. So that concludes this morning's meeting. Thank you.